Hello everyone. Thank you for tuning in to our review of the second quarter of 2022. My name is Jeff Hedrick and I am a private wealth advisor for Inspire Financial Planning. We have teamed up with YCharts to bring you an economic update summary. We hope you gain some insight from our presentation and that it inspires you in some way to become a better, more informed investor. Today we're going to take a closer look at what happened in the second quarter ending June 30th. In doing so, keep in mind that there are a couple of opportunities to take advantage of by listening to this presentation. The first opportunity you have is to become a more informed investor. The second opportunity you have is that you can become a more confident investor. And it's hard to become more confident in the investment world without doing some studying and some disciplined homework. Fortunately for us, YCharts has done most of the homework for us, so this is something to be excited about. If you have 10 minutes to spare and a hot cup of coffee at the ready, today's presentation should be pretty easy for you. So let's get started. These first few slides are filled with market data. Simply put, this is quantitative information showing you how different segments of the market performed over a specific time frame. U.S. stocks fell further in Q2 after a dismal first Q1 2022. The NASDAQ composite was hurt the worst with a decline of 22.28%. The international picture was much the same, with the MSCI World ex-USA index falling by 14.44% and emerging markets down 11.34%. But let's stop here for just a second. Having lived through the investment world personally when the Twin Towers fell back in 2001, and then again as an investment professional in 2007, 2008, and 2009 during the global financial crisis, it is my opinion that these numbers at this point are actually not that bad. The max drawdown during the financial crisis was negative 50% plus for some asset classes. So while there is a part of me that is unpleased with the current direction of the stock market, there's another devil on my shoulder, or perhaps it's an angel dressed like Peter Lynch or Warren Buffett or even Gordon Gekko, telling me that this is a great time to buy. Not a single S&P sector posted a positive return over the course of Q2. Each one was in the red. The defensive sectors did hold up best, with consumer staples returning negative 4.19%. After an exceptionally strong Q1, energy also sank lower, but only by minus 5.45%. The technology, communication services, and consumer discretionary sectors all fell by around 20% or more. This table shows the performance of asset classes over different time frames. Since this slide deck includes data as of June 30th, 2022, the year-to-date and 6-month total return columns show the same figures. Commodities once again performed best, returning 2% in Q2, and they are now 35.8% higher year-to-date in 2022. However, the rightmost column showing 10-year total return indicates commodities are slightly negative even since mid-2012. U.S. growth was hit the hardest in Q2 in a crushing minus 20.9% drop for minus 28.1% year-to-date. Emerging markets continues to lead equity asset classes but still fell 6.6% in June alone. This visual shows historical quarterly asset class performance for the last 15 quarters. Commodities are back on top for the 5th time in 6 consecutive quarters, and once again the only positive asset class for the quarter. U.S. growth and U.S. small caps remain the bottom 2 asset classes in that order, returning negative 20.9 and negative 17.2% respectively. This slide points out various risk versus return strategies. including stock-to-bond allocations of 80-20, 50-50, 20-80, and 100% equities. The S&P 500 fell further, down nearly 23% from its all-time high on the first trading day of 2022. The 20-80 allocation outperformed over the previous year, down only 10.5%. This visual demonstrates the value that diversification can provide investors during turbulent periods. And this is another example of how diversification can mitigate risk. Next, we will explore bonds and interest rates. The second quarter of 2022 brought a lot of action in the yield curve. Treasury rates continue to rise across the board, and by so much in the short end that the yield curve has flattened to the point of inversion. The 5-year Treasury rate ended Q2 at 3.01% and was greater than the 10-year rate's 2.98% yield and just shy of the 30 years 3.14. An inverted and flatter yield curve can indicate uncertainty about economic growth in the long term. Update: the 10-to-2-year Treasury spread fell to a 20-year low of 0.22% shortly after the quarter end. So that was an adjustment after we had been compiling most of our data at the end of June 30th. But I do want to pause here for just a second. While the Fed is increasing interest rates at a record pace, this is in itself a very good thing. Money has been flowing far too freely over the last few years, and this has led to too many dollars chasing too few goods. But the Fed's ability to raise and lower rates is just a miraculous tool. Speaking of tools, while I love the new set of Allen wrenches that I ordered off Amazon recently, I have to be careful that I don't over-tighten what I'm working on when I'm using this particular tool. And I'm comparing this to the tool that the Fed has to raise and lower rates. And not to be a harbinger of hope in an era of negativity, but I believe that the knowledge that the Fed possesses is greater than it's ever been. And this knowledge, or rather the ability to learn from past mistakes, may allow us the opportunity to make better decisions going forward. Next, we'll explore macroeconomic data from key economic reports published recently. This table is a heat map of various economic data points which are considered leading indicators and shows their trends over time. The first 6 columns show a quarter-by-quarter change, whereas the last 13 columns show annual changes in the data. The U.S. Index of Consumer Sentiment is at its lowest level in more than a decade, sinking to 50 at the end of Q2. The 10-to-2 Treasury yield spread continues to hover around 0, inverting for the second time this year, just after the end of Q2, which we mentioned earlier. The Philly Fed Manufacturing Activity Index also dropped below 0. But this would also be a good screen to pause and explore. That's one of the things I love about these webinars. You can pause them at any point, look at the graphs, question things, maybe cross-reference something on another screen that you have a question about. But 2 main reasons that I want you to stop on the screen. Number one is because when you look at business inventories, housing starts. I'll give you a second to find those on the screen. Inventories, housing starts, and building permits. We see a difference between now and, say, 2008, 2009. It's not as bad. Reason 2, if you look at the dire circumstances surrounding 2008 and 2009 and compare them to the left side of the screen, again, this is just comparing 2 different economic times, you might be a little bit relieved, at least if we were looking at just this screen or just this graph alone. My thoughts here, and again this is just my opinion, is that other than consumer sentiment, we are not anywhere near the world we were in 2008 and 2009. And we got through that just fine from an investment perspective if we didn't panic and sell. One of my favorite investment sayings is invest when there's blood in the streets. It may not be a bloodbath currently like it was back in 2008, but there is certainly enough blood trickling through the streets to propagate a few buys on the equity side. But do your own research. Challenge anything and everything, including the data that I'm showing you. But in doing so, you may see more opportunity than others, which could be to your benefit in the long run. This slide shows the trade activity between the United States and other key partners. U.S. trade balance on goods and services continues to reach new all-time lows. The chart on the left shows that U.S. imports have climbed significantly higher than pre-pandemic levels, now at $988.41 billion per quarter, and U.S. exports have also exceeded pre-pandemic levels. The chart on the right shows how this divergence of trade imports versus exports is causing the U.S. or the lowest U.S. trade balance ever recorded. The table below shows how imports have increased year over year in all regions. At the end of Q2, service imports from Mexico had the largest increase year over year at 55% to the black. The beginning of 2021 saw the lowest 30-year mortgage rate in decades. Since then, mortgage rates have shot higher, ending Q2 at 5.7%. The US dollar to euro to pound sterling to Chinese yuan and to Japanese yen exchange rates have all increased to near 52-week highs in Q2. Update. This has been added since June 30 quarter end. In early Q3 of 2022, the US dollar approached near parity with the euro, something it has not done since 2002. Charts of the moment. Next are some visuals depicting trends that are impacting the markets and investments, and this will bring us to our last few slides. Since 1950, the S&P 500 has fallen in the first half of 23 calendar years and risen in the first half of 50. Of those 23 years, the S&P completed a comeback in just 8 of them, the most recent which came in 2020. While going 8 for 23 means that the S&P 500 has converted a negative first half to a positive full year only 34.8% of the time, 2022 is the third worst first half since 1950 for the S&P 500, down 20.6% at the half. Only in 1970 did the index come back from such a poor start, a year in which the S&P finished at 0.1% in the black. Though wage growth given by U.S. average hourly earnings has been on the rise, other inflation inputs have risen faster. As a result, real average hourly earnings are now below pre-COVID levels. Lower now than it was amid the 2008 financial crisis, consumer sentiment has fallen to 50 as of Q2 2022. This may be one of the reasons that we are starting to see some attractive valuations in the market, suggesting an opportune time to be more bullish where sentiment has temporarily outweighed value. While it's no secret that the S&P 500 is market cap weighted, an outsized percentage of market cap losses can be attributed to its largest constituents. FANG M stocks, Meta Platforms, Apple, Amazon, Netflix, Alphabet, and Microsoft are responsible for combined $3 trillion of lost market cap, While the index's top 25 losers, still just 5% of all names in the index, contributed 61.5% of the market cap losses in the first half of 2022. Examining the S&P 500's top 10 losers by market cap, Apple, Amazon, Microsoft, and Tesla have been leading the index lower. Recent inventory crunches, allegedly driving price increases and inflation, at least in part, are starting to ease as the percentage of held inventory to sales volume moves higher for wholesalers, businesses, and retailers. The 2-year, 5-year, 10-year, and 20-year Treasury rates have all risen into 3% yield territory in Q2. In July 2022, the 10 to 2-year Treasury yield spread briefly inverted. Inspired by Ben Carlson's CFA piece comparing inflation in the 1970s versus inflation in the 20s. You can see this at Ben Carlson's blog, A Wealth of Common Sense. And the blog was called The Last Time Inflation Was This High. Hailing from their COVID highs, major cryptocurrencies are down drastically in 2022. While some investors might be saying, wow, I'm glad I didn't buy crypto back in the fall, others might be relooking crypto now and thinking, wow, this could be a good time to DCA into this asset class. For those that are not familiar, DCA stands for dollar cost average. This is where you make multiple purchases over a period of time. Here are some sources for today's presentation. And there is a lot to break down in today's presentation, that's for sure. Depending on your personal tolerance for risk, as well as your time horizon, recent markets could suggest that it's time to hold most positions that you have. Or, depending on your investment methodology and conviction you have to act on it, it could also be time to buy stocks in areas that you feel are attractive. Please keep in mind that we also believe that investing is a team sport. It's always good to consult with your financial advisor as well as your CPA to get good input before you pull the trigger on a buy, especially during such a volatile time. If this is something that we can help you with, please feel free to reach out to me at 910-448-1450. This is what we're here for. This is what we do. We exist for markets such as this. If you have a question or concern, please feel free to reach out to us, and I will be happy to discuss your options with you. God is good, the markets are not all bad, and we look forward to joining you again at the end of the third quarter for another update. Thank you so much for joining us for today's